Welcome to the Intelligent Investing Podcast, where modern portfolio theory can suck it. A student of the School of Graham and Doddsville and a clergy member of the Church of Warren Buffett. Here's your host, Eric Schleien.
Hi, this is Eric Schleien. You're listening to the Intelligent Investing Podcast. Today we have Glenn Surowiec on from GDS Investments. Glenn, welcome to the show.
Hi, thanks for having me, Eric.
Yeah, it's been a little while of back and forth to get you on, of rescheduling. So I'm finally glad we're able to do this.
Happy to be here.
Yeah. So tell our listeners, for those who don't know who you are, a little bit about who you are, what you do, a little bit about GDS Investments, and then we'll get into it.
Sure, no problem. So GDS Investments, I run a separately managed account business outside of Philadelphia, manage money for individuals and families. We are long only. I custody those assets at Schwab and TD Ameritrade. And it's essentially a portfolio of 15 to 20 different positions, so it's fairly more concentrated. People ask me a question about, sort of how I invest that. And I think the easiest way I can answer is, obviously, I'm very, very schooled and I certainly adhere to a very strict value investing orientation. And I think within that, I'm trying to arbitrage the difference between stock prices, which are, very sort of driven by emotion and tend to have a wide range in any given year or two, and business value, which has a narrow range and is generally rooted in cash flow. So if I can kind of find a difference between those two, on the long only side, obviously it's those situations I'm trying to get closer to.
Now, when you say you're arbitraging that, are you doing more, say, shorter term? When I say shorter term, as a value investor, like a 1 or 2 year investment where you feel it's like a company's fairly valued, you're going to sell it, or are you really holding these securities for the long term, or is it a mix of both?
Yeah, so I think it's somewhere in between. I mean, I sort of have an informal rule with clients where I don't kind of keep score until we've at least owned something for 24 to 36 months. So great ideas have a way, sort of have a different timeline in terms of how quickly they pay off. I mean, I've owned companies where they did nothing in year one, they did nothing in year two, and sort of had this back end loaded payoff. And these are companies that are widely owned. They're followed by 35 or 40 different research analysts. I mean, it's not like they're very, they're under the radar. And that's just the way it is. And Bank of America was an example where, here's a company that obviously is very, very known. And, this is after Buffett had put in preferred stock. And so it obviously had that added visibility. So I owned it at 8 and went to 5, and it sort of hung around there for a while. And, then it had this huge payoff in year 3 and year 4. So obviously I would love to buy something today and have it work out very, very quickly. Unfortunately, you have to control the controllables in this business. And part of it is patience is kind of the cornerstone of everything I do. And, every idea I get involved in, I'm really trying to just be mindful that if you have the thesis nailed, then let's sort of not really kind of get into any deep conversation about, success and failure until at least year 3 or year 4. And typically 36, 48 months is enough to kind of see if you're right or wrong.
That makes sense. So if I'm coming on as a new client of yours, since you do a separately managed account business, it's interesting. I don't talk to a lot of people that have SMAs. I'm like the freak out there that has an SMA business and not a fund structure. When you have someone new come in, are they invested in the same securities as everyone else? Are you customizing it to their needs, or is it going to be slightly different based off how cheap things are? How do you look at that?
So That's a great question, and I think it's one of the structural advantages of running an SMA. I mean, in addition to just kind of the transparency vis-a-vis like a mutual fund or hedge fund structure where, certainly clients know what they own, they get trade confirmation. So there's a high level of transparency. But my idea set changes. And so the great thing with, a client who comes in today versus a client who came in 3 months ago is, are there some securities that are, as cheap or cheaper today that they were 3 months ago? Of course. But there's also some companies that I bought 3 months ago that have moved up considerably and are not quite, they haven't sort of, they're not ownable. I want to say they're not something I would purchase today. So, it's a very, very dynamic process, and the idea set is kind of ever changing. Especially when you get a spike in volatility, where there's just things that kind of move up and down, and there's ideas that that weren't on my radar screen 3 months ago that are today. And obviously the corollary to that is there are things that 3 months ago were really, really great buys that just aren't today. And so I really try to customize it and not just put people in some, cookie cutter portfolio that, may have been better suited for them 3 months ago. So, there's environments where I have gotten clients quickly positioned because there was just more great ideas than cash. And there's environments where it's taken me 18 months to get clients fully positioned. And so I try to take a very sort of holistic view in terms of if there's just not a lot of great ideas, then I have no problem owning cash, and I will wait and I'll wait and I'll wait. And if there's just an avalanche of high quality things to do in, 12 months or 18 months, then I'll go from a position of having lots of cash to a position of being fully invested. And so I think really that's the beauty of running separately managed accounts compared to the average mutual fund, where the average mutual fund, they get $1 and it goes right in the market and they're typically fully invested. It's also a big advantage versus a lot of how index investing works. And we can get into that a little bit if you want. But
yeah, we can get to that a little bit later. When you're managing these separate accounts, does it ever get overwhelming keeping track of every single one if they're all going to be a little bit different? And then also, how do you do with fees? I mean, do you keep a little bit of cash in the account to pay the fee, or how does that work structurally wise for you?
Yeah, so fees are there's a little bit of cash. I mean, my management fee ranges from 1% to 1.5% depending on asset size. Mm-hmm. The way I manage so it's a scalable business, but you have to do it in an intelligent way. So the way there are certain levers you can pull to make sure you're scaling assets, but not taking on more accounts than you can manage. And obviously the way to do that is just increase your minimum account size. And so my minimum is $250. I would say my median account is, in the threes, and I'll accept clients, and I have several clients that are in the seven figures, but there's someone that has less than 250. But I feel like it's a relationship I want to be in, and I feel like they need help, then I'm certainly happy to take on that relationship. But
you saying that gives me a little bit more validation in that I had increased my minimum by a lot when I started. People were like, "What are you doing? You can't increase your minimum to that much." And I'm like, "Well, I don't want to be taking on like a bunch of these like $10,000 accounts."
Yeah, you don't want to do that. There's a sweet spot.
Right.
It all comes down to the business answer to that is you can't scale your business by bringing in a bunch of $10,000 account. Mm-hmm. And then two, the value of what we do obviously goes down quite a bit with $10,000 accounts. So my strategy works, but you need like 150 to kind of make it work because I only own 15 names. So, but at the same time, there's people that I know and people I care about, and there's people that are sort of lost and people that are in jobs and they have money tied up in a 401k and they leave and they don't really know what to do, and a lot of times that 401k was built to benefit the employer and not the employee, and so they call me and I'm not I'm certainly going to return their call, and so there's a personal side to this business that I haven't quite I'm not willing to just ignore. So
well, that's cool you're able to attract those kinds of people. I have found personally, it's funny, I don't share too much about my personal business on here, but I feel like a special kinship that you're having the same kind of structure as me. I have found personally that I've always wanted to help people that may not fit the minimums and all that, but generally the people that have actually wanted to invest with me have been more of those larger accounts, have been more of the people that, quite frankly, probably half my investors could just do this themselves if they really wanted to. And I found the people that were kind of lost that I felt I could help generally would rather just go with a more traditional, advisor or someone at JP Morgan than someone like me, which is fine. But I just always found it a little interesting.
Yeah, I think I have kind of found both types of people in both categories. So I do have some relationships where they're not ultra high net worth. They have money, but a lot of it's kind of tied up in traditional sources, whether it's like real estate. I mean, it's not like they have a pile of money kind of sitting on the side. So a lot of it's retirement stuff, and so. I think that the relationship I have with them is definitely deep and it's built on trust, and I think that they know I'm not willy-nilly when it comes to this sort of stuff, and so I think they are comfortable with the path that I'm bringing them down, but they're doing it based on the trust that's sort of inherent. Now, so I would say that
I think you have to in this day and age. I mean, there's so many people out there that, if you don't like the person and trust the person in the first place, it doesn't matter how good they are. They're not going to put money with you.
Yeah, and so let me just build on that. Is that if someone comes to you and says, "Hey, listen, I got money with whatever ABC brokerage," and they're not, they don't really do any research themselves. Everything's kind of farmed out. There's this big kind of, and there's this double fee structure because the advisor is charging money and then they in turn are putting money into mutual funds. And the client is not really even in the passenger seat, let alone the car. I mean, they're just sort of, they're not really, they're almost in the trunk.
Yeah.
Okay. And so when I see that, I want to put an end to it. I think there's a lot of that exists in this industry, whether we want to recognize that or not. And so I don't know. I sort of feel like a duty that if I can at least tell people that are somehow sucked into that and say, okay, listen. And sometimes it's a conversation and sometimes it's not a fit because of, maybe there aren't enough assets there, but I can kind of help them in another way, at least nudge them away from.
And I was going to say, there's a way to have that conversation because usually if you're like, well, you're the guy you're using is just a total scam artist. They're like, oh, well, I know this guy for 15 years.
Yeah, you
can't say that.
Yeah, no, it's a delicate conversation,
yes, very much
but
so.
with every conversation is different. There are some people where you can come at them with fastballs, and there are some. It's like, hey, maybe you just highlight the benefits of a new scenario as opposed to, telling them that, the old zip code isn't really kind of where they wanted to be. You just kind of talk up the new zip code and it's like, oh, you got better schools over here. You got parks, you got, and so what I try to do is just say, hey, listen, this industry is like a lot of other industries, and it's probably an industry where there's a lot of people that have kind of created shelf space the same way that Coke and Pepsi have in the supermarket. And it's they've certainly sort of bought themselves, and a lot of investments have obviously bought themselves high-level shelf space. And so, I think that if you can kind of bring knowledge and, maybe declutter something that is extremely confusing, then I think they're grateful. And if it turns out that they can also become a client based on things that you're looking to do with your own business, then great. And if it's not really a fit for a client, then at least you've kind of pushed them in a different direction. And but that's, I mean, at the end of the day, if you want to scale this business, then obviously the easiest lever to pull is to raise your minimum.
Yeah. Do you write letters to your investors, or how does that work?
Yeah, twice a year. So I've tried kind of different. I was just gonna ask if you have different securities in different accounts, how does that work? There's a lot of overlap, and so I think how it works because there's a lot of clients that own similar securities, and there's some that don't own, and I try to focus on those. And then clients always know that there might be securities. And so if I talk about something, and let's say I talk about 8 different companies and you only own 6 or 7, on the front end, I have a conversation and I say, here's why. And so they understand it. They understand that I'm writing a letter that will be, for the most part applicable, but not like 100% so. So, and then
are you reporting like a consolidated performance number, or?
So that is more of an individual exercise and more driven by like a year-end kind of, let's have a call, let's have a sit down, and let's kind of go over different things. But because you got to be careful about quoting composite figures in a letter where you have, accounts within that, if you're up 10, you might have one client that's up 6, another client that's up 18. So you just got to be careful about all that stuff. It gets dicey, and I really want to just focus on my letter about, 1, reinforcing the strategy, 2, maybe talking about, different companies where there might be something actionable that happened, and just using it as sort of a way to, just bring them closer to what they see in their portfolio, and closer to, maybe the 2 or 3 things that matter most, as to why they own it. And just, I think it allows also, it's actually very good for me too, to kind of think through a lot of these issues and put it in paper, and I'm happy to share those letters with you too. I mean, I actually enjoy. I put a lot of time into them, and I enjoy doing it. And it's only twice a year, so.
Okay. Well, if you'd like, we can put a link to some of your letters in the show notes afterwards.
Yeah.
Okay. Cool.
That'd be great.
Are you finding it tough, with this move to passive investing over the past, I don't know how many years now? It's been quite a while. Are you finding it harder to find things, or compete with just what pretty much seems like ever expanding capital flows into indexes and ETFs?
Well, it's a challenge. I would say it's cyclical and not secular. So we've seen this challenge before, and we've seen it play out. So you kind of saw in the late 90s, I think there was just a lot of attraction to the indexes, and because I think at the end of the day, I think when you have a vehicle that is essentially a buy high, sell low vehicle, and the underlying backdrop in the market is a momentum driven market, then it would stand to reason that index investing is going to become more popular, because it becomes an exercise in low cost, and you get the benefit of a momentum backdrop. So, and that's kind of what we've seen here over the last, certainly very pronounced over the last couple of years, where the gap between value and momentum has certainly widened based on historical standards. But so I think I'm very aware of kind of what's good about index investing, and I'm not drinking the Kool-Aid either. I think there's also some real big weaknesses too, and I think like a lot of things, I think people ignore weaknesses when times are good, and they tend to highlight strengths, and obviously when times aren't good, they tend to just focus on weaknesses and maybe ignore some strengths, and that happens with underlying investments. I think index investing, it's like at the end of the day, there's nothing structurally. It's a vehicle that owns underlying investments, and so can you have a bubble? I mean, of course you can.
Well, do you think? I mean, would you agree with Michael Berry that index funds are in a bubble, or do you have a different? Okay.
Yeah, I agree with him 100%. So I think if
and for those who actually aren't familiar with that thesis, can you give us a little rundown of the idea of why indexing is in a bubble, the dynamics of how that works structurally? I think that'd be interesting for a lot of people to hear.
Well, so bubble is just a terminology, right? And so Burry has kind of used it because he's been kind of connected to previous bubbles, mainly the housing bubble, and so I think someone used that term just to be consistent with, all right, here's a guy who sort of was, who had sort of shorted the housing bubble, and
for those who don't know, he's the guy that was featured in that movie, The Big Short, and in the book. Good movie, by the way. If you
very good.
Yeah.
So, I mean, the idea is that is there a level of complacency now that a lot of the indices are hitting highs? Is there a level of complacency? And I look at like fund flows and things like that. I mean, certainly when you have massive amounts of money moving into a particular asset class, I think it should always give investor pause, and that's not, index investing doesn't have a monopoly on that. I mean, you can look at fixed income right now and you say, is that in the bubble? Well, it's been in a 35-year bull market, and the 10-year has a one handle to it. So I'm not investing. I'm not a big investor in fixed income right now, and so does that asset category give me pause? Yes. But I think within equities, we saw this in the late 90s where there was the have and have nots, and everyone embraced index investing, and they embraced kind of really the names behind it. And in turn, that's what, so people think index investing and they think of like, okay, here's a cheap way to get access to the market. But beneath that, when you have subsectors that are sort of taking over and become, such an outsized influence on the underlying index, then really the intent, the original spirit behind what the index was supposed to be becomes totally lost, right? So you have,
also, I don't think it's as cheap as people think too, right? Where because you also, right, the index is typically, I mean, I've never heard, maybe it happens, but typically, a Vanguard fund that's a large stakeholder in some of these very large companies, if management decides they're going to go give themselves a pay raise, those funds typically just rubber stamp anything that management asks for, right? They're not like fighting proxy battles and stuff like that, or going against management typically.
So I
think one
on the list of they have failed from a governance.
Oh, it's horrible. Have you seen how much salaries of executive compensation has just blown up over the last 10 years? It's actually kind of insane.
Yeah. So I actually
that's a real cost
points,
to investors.
I'm really, really glad you brought up that point, because
I just want to say, like, this whole idea of like, well, you're only paying like a 0.04% fee. It's like, well, actually, what's been the cost to investors over the last 10 years on like new executive compensation packages and option dilution and all that? I mean, it's like you're talking about real numbers. It's not like it's more than 1%. I'll tell you that much.
So they can't have it both ways. they can't say we're cheap and we've essentially put the investment process largely on autopilot, which I would argue is either good or bad depending on where we are in the cycle, but that's fine. And at the same time say, but ignore the fact that they put the governance process on autopilot as well. So we're sort of at the ground zero of Vanguard, right? I mean, locally, right? I mean, because it's a local business. And so I know a lot of people work there. You would be underwhelmed by how understaffed, not so they're getting better because people have kind of like forced them. But how do you have a firm that manages trillions and trillions and has such a small governance and proxy department? Because essentially it was never a focus. They were essentially just voting with management. And so, people talk about income inequality and all these other things that have kind of come up. It is directly correlated with the gross and passive investing. The reality is that I think there are so investors kind of need to just wake up and say, okay, let's think about maybe this a different way. So like I'll put on the table some of the strengths, and then I'll sort of talk about the negatives, and I'll try to do this as quickly as possible. But is index investing cheap? Yes. Okay. And I agree with your point that there are a lot of costs that people aren't accounting for. But let's just say it's cheap, at least on paper. Is it simple? Yes, it is simple. Okay, I get that. Are they fully invested in a particular asset class? Yes. Although I will put an asterisk next to that because I actually think that's an asset or liability depending on where we are. But and then so let's kind of flip over and talk about some of the flaws. And no one really mentions any of these. And so I'm glad like Burry at least like put these on the table, and I'm glad that you've kind of mentioned that and done the same thing.
Before Burry came out, people would roll their eyes at me. I've been talking about this for years now, and no one has seemed to care until it became a mainstream thing with Michael Burry. But even that it's funny, even that has drove some of these more traditional financial advisory firms to create YouTube videos dismissing him and saying, well, he doesn't really get it.
Oh, no. There's definitely a Kool-Aid component to this thing. I mean, there's a cult that exists, and people do not want to. And I'll talk about Buffett in a second, but
people love using Buffett to justify all this. But yeah, go ahead.
All right. So Seth Klarman, he has always talked about just the importance about having optionality and cash and how kind of intertwined that is to his long-term success. And so, that's kind of how I think about investing. And I think earlier in comments about, I really just take a bottoms-up view. I mean, if there's an avalanche of great things to do, great, be fully invested. Absent that, have cash. So I think, just to be totally kind of, frank, the ability to buy assets very, very cheap during times of like chaos and distress is a huge strategic advantage over the long term. Okay, so that's number one. The second huge flaw is so intelligent investing isn't buying high and selling low. There's not only in equities can you somehow spin that as an advantage. That's awful. That's dumb investing. And so I've always really you have very sensible people where you can say, hey, listen, I'm going to give you two options, right? We can buy a foreclosed property from a bank who's just interested in getting rid of inventory, and we're going to buy it at whatever $100,000 and it's fully leased out, fully rented, whatever, and you're going to make $20,000 rent. All right. Or you can buy a similar property, but you're going to buy it whatever retail from a pretty sophisticated seller, and whatever, you're going to only get $5,000 in rent. So like, which one's better? So like they understand the concept of kind of valuation as applies to certain asset classes, but I don't I don't think they particularly understand this dynamic that's in place and how indexes rebalance. It's like, it's clearly looking in the rearview mirror, not through the windshield. I'm interested in looking through the windshield. I want to know what's going to do well. I don't necessarily, what's done well is history. And so the idea that you have a vehicle that just reallocates more and more percentage-wise to things that have gone up, there's nothing intelligent about that at all. So anyway, I think people on the surface sort of get that, but I think they're just really, I don't know, either they don't want to. We talked about the governance issue, and I think the last issue, which tends to kind of, so this is sort of the trap issue, right? Because after you have a very, very long bull market, people sort of forget that these are really, really niche products, and they work well in a rising market. And, so here you are, so year 8, year 9, whatever, I think people just kind of think that things are going to go on forever. And obviously that's not going to happen. And I think, we're in a market today where, there's many, many, many more companies that are either fairly or overvalued. So it's really going to be important to identify maybe the 10 or 15% that have been kind of left out.
Right, so it's an interesting market, right, where I have found things that seem just, crazy undervalued. And then there are companies that are a lot more mainstream, almost always part of an index, and the valuation couldn't be any more different. I'm 31, so I think I'm younger than you, but in my lifetime, I've never seen so many different kinds of valuations depending on what pocket of the market you're looking at.
I agree.
It's kind of weird, right?
Have-nots, the disparity between have and have-nots is very, very wide. It's like the late 90s. Not necessarily quite to the magnitude, but directionally it's very much like the late 90s. And so I'm slightly older than you. I'm 48.
Okay. Still a young guy.
I say that laughing. But, I was very active in the late 90s. And so I can remember that sort of last really big kind of value versus momentum cycle where, value dramatically underperformed and it hurt a lot of people, and people were kind of questioning the legitimacy of the, Buffett Graham strategy and all these things in the late 90s. I mean, the market, if you're patient, the market will essentially fix itself and value will ultimately connect to price. And so go ahead.
No, I do think there is one difference that I think it's important to talk about between right now and the 90s, which is in the 90s, you had a lot of these tech companies where the business model was very, very flawed. They were never going to make money. Or the amount of money they were going to make just made absolutely no sense compared to what the price was, right? So you had the thesis of the internet is going to change the world, and you're going to have this exponential growth that we've never seen in the history of the world. And they were pretty much right about the internet and that totally changing the world, but then the valuations didn't match. I think what's different today is you still have business models that will go away, but you do have a lot of business models and disruption that are actually profitable and are actually making money. And if you model that out, the valuations, if you say, okay, this business will be here in 10 years from now, then the valuation all of a sudden isn't expensive anymore. So I think that if you're just looking at measuring value on a traditional price to book ratio, or saying, oh, this company isn't making money right now, when maybe they're just deferring profits and reinvesting back into the business, you may miss out on what looks expensive actually isn't. And on the flip side, what looks cheap may not actually be cheap. I think I think the game has changed somewhat.
Okay, so I have a couple of responses to that, and I'll kind of start in reverse because I agree. So I look at value. I'm not big into like screening and things like that, and I'm not don't necessarily look at like traditional measures of value. Okay, this company's low price to book or low P.
Well, a lot of people do, which is why I said that.
A lot of people do.
I mean, if you look at the charts, right, where it's here's a big discrepancy between growth and value. I think it's important to look at that, right? I think it means something, but at the same time, what value means in 1980 is very different than what value means today. Correct,
but here's what I'll point out.
Yeah, go ahead.
I think the valuation disparity today has to do with short-term versus long-term. So companies that have problems today are just getting whacked because there's zero tolerance. You don't have any owners, you have renters. And so if you can actually, the value of thinking out like 2, 3, 4 years and say, okay, yeah, this company's got problems today, but really, if you look under the hood, it's actually a decent business, and there's a lot of things that are kind of happening, and they're actually moving in the right direction. They brought in a new CEO, and he or she's doing like A, B, and C, and maybe there's some noise in the income statement, but a lot of that's going to kind of go away. So I think it's more short-sighted versus long-term.
I couldn't agree, Glenn. I couldn't agree more. And I would even go further to say, even if a company isn't having problems, but it doesn't necessarily fit into a perfect category box, and therefore isn't on an index, isn't in, part of an index fund, or
right.
The business model might have a few different divisions, and if you even do very basic work, you're like, holy shit, this is really cheap. Why is it? And then it's frustrating. It's like, well, why is it so cheap? Oh, because it doesn't perfectly fit this category. And sometimes that's the answer.
Yeah, it just hasn't. It's like not growing enough, or in a lot of cases, there's some turnover in the shareholder base where it was kind of this high grower, and now it's kind of matured a little bit. And the name I'm thinking of just right now is like Box or something, like, so Box obviously had a lot of organic growth, and it was just, they kind of, they came out, and there was just a lot of easy growth. I mean, I'm not saying there wasn't hard work behind the scenes, but then they sort of grew up a little bit. And it's like, okay, they have a great product, and Gartner and Forrester absolutely love it, and now they're trying to like figure out, do I reinvest so much money that it's going to hurt my margins to sustain high growth, or do I figure out a better balance between my growth and margin profile? And I'm just using them as an example, but so coming full circle on your comments, I think, so there's always a tendency to kind of extrapolate out and kind of take what's loved today, or maybe companies that are leaders today, and just kind of like extrapolate that out in the future. And
yep.
The stuff of business obviously is much more disruptive, and you can look at that so many different ways. I mean, you go back 20 years from now and look at like the top 20 companies in terms of market cap.
It's almost all different, yeah.
Yeah, and then now look at them and look at, how many of them are irrelevant. Like if I told you that in 2000, companies like Lucent Technologies and Nokia and IBM, and let's say we were sitting here in 2000.
Yeah.
And Nortel and Sun Micro, and I would say, or these companies are going to be irrelevant, or just less relevant. That would be unthinkable. How can that be? And it happens, and these are big companies, and these are established. So I'm not saying I love companies that have a tailwind, and I love that companies have a moat. And I would just say though, there's a lot of companies that are priced as if the moat is indefinite, permanent, long-term, where, I don't know, maybe it lasts another 5 years and then it starts eroding, but it's not going to last another 25 years, maybe. And that's kind of what the market's pricing in. So there's always that kind of, that tug of war between where the market's at, what is pricing in, and what's kind of reality. And to the extent there's a difference there on either side, I think that's the opportunity. And so, anyway.
Yeah. Do you invest in any, special situations or more obscure businesses on the smaller side at all?
I have. Yeah. I wouldn't say it's core to what I do.
What would you say? Is there a certain, like, where do you spend most? Is there a place where you spend most of your time or a focus generally?
So the fact that I own 15 or 20 different positions has kind of led me more toward not bigger companies, but just companies that are, a little higher market cap. Yep. And, little less volatility. And, there's a business component to this. I mean, yeah. So if I was managing $1 billion and it was 100% captive, and, I knew that the owners of that money could handle volatility, then, but if you have 15 to 20 positions and they're all like sub 1 billion market cap, you're not going to have a business, right? I mean, eventually you're going to get to a point where, that category's out of favor and there's just, a whiff of volatility. And next thing you know, your portfolio is down 20% a month and clients are like, okay, I didn't sign up for this. So there is a sweet spot. You have to really understand the underlying psychology with the average client in terms of what they can handle kind of month to month, quarter to quarter.
Yep.
And to be perfectly honest, I've had clients where, we've had a relationship for like 3 or 4 years and, I did very, very well for them and, they're down 10 or 15% in a month. And obviously we've you kind of go back and there's months where like stuff happens, and Q4 2018 was an example where, it was a really, really bad quarter. And they're gone, right? I mean, people are really emotional at the end of the day. And I think it's only heightened by the fact that they can kind of check their portfolio all the time and the internet, and they're reading lots of things, and, they get worried, and I think they're inclined to kind of act on that worry. So, you have to really be a little bit realistic with the strengths and weaknesses of this business and make sure that you don't get too doctrinaire with, okay, this is what I'm doing. I'm only going to buy companies that are 200 million or less. And I get it. There's fewer people that are looking at those companies, and there's, a greater chance that you're going to buy a company that's worth X for a quarter of that, right? I get all that. So, but the reality is that it's not for me because it's not for my clients. And so I'm really representing them. And I think there's enough to do kind of, sort of north of 2 billion or 3 billion or something like that. But, to answer your question, have I owned kind of odd things that have kind of happened in the market? I have. Certainly I had several of those in 2008 and 2009 where, there was just people that in the effort of raising liquidity were selling, companies for like $15 million that had like no debt, real estate that was worth $50 million conservatively, a business that was cash flow positive, even at the bottom of the cycle, and they had, $100 million in cash in the bank. So,
yeah, it's kind of hard to pass up on something like that.
Yeah, and no debt. So yeah, I mean, I certainly have had, but absent an environment like that where there's just huge dislocation, you got to be somewhat sensitive to what clients can handle.
Yeah. Are you cool going into maybe one or two names of some interesting things that you're either looking at or own?
Yeah. So I mean, I'll talk about one name that, and I'll sort of do it in a way that because I've already talked about it before in kind of different ways, and
I typically do find that being able to talk about something specific definitely makes for a more interesting show.
Yeah. So all right. So I mean, but a typical company for me, let me just kind of talk about like general company A that I would be interested in. It is a company that I think maybe, investors may or may not be familiar with. I would say they're more inclined, oh yeah, I kind of know that company. They might not know a lot about it. or what they do know about it, maybe it's just based on, the last thing they read or something. And it's probably not flattering. But I tend to look for companies that are well managed, have strong balance sheets, are under earning for some reason. And it could be based on cyclical factors. It could be maybe because it's a conglomerate that, maybe there's two divisions that are doing well and the other one is not. And so that third division is kind of masking the overall profitability of the firm, or at least making things look messier than they would be otherwise. But maybe that third division has some value to a strategic or financial buyer. So that, if I can kind of bring those factors together where the market is kind of given up, or the market is just maybe not thinking about how the business can be reconfigured, out year 2, year 3, or year 4, because they're so focused on how it looks today, then that would be a typical situation. But I do want an underlying strong core business. And then I would say there's a category where, the turnaround is a little deeper. And so maybe I'll kind of talk about one that is sort of in the news. And that's General Electric.
Okay. Yeah, that's been just a little bit in the news, right?
The reason I like it is because it kind of reminds me of Bank of America, so back then, well, I'll give you 2 examples, and these are old examples, and they both worked out. So one was J.P. Morgan, where I mean Jamie Dimon is, the gold standard for CEOs, let alone ones that work in financial services. But always had a lot of respect for him. So after the London whale crisis, J.P. Morgan goes to $30. Very, very easy decision. Buy. I don't. It's 120 now. I didn't ride it all the way up, but I did make a lot of money off it. Very, very easy. Like you had Jamie. They were like number 1, number 2 in everything they did. You read his shareholder letters. Everything was spelled out. They just had a bad quarter, right? They're in a business where occasionally you're going to have that. There's going to be some trading volatility. And they lost something with a B in it, but they were certainly well capitalized, and they were going to come out the other side just fine. And then you have, maybe a slightly different situation in the same industry, and I also owned, and I mentioned them kind of briefly before, with Bank of America, where there was a lot of confusion, kind of how they were going to end up. And I actually owned them not kind of in the middle of the crisis. I owned them in 2011 after they had kind of come out. They were already recapitalized. The government was involved. They had, put money in via TARP. And they were kind of on their path to de-risking the firm. And you had an opportunity to really kind of take another bite there, where the stock was at 10 and, it ultimately kind of bottomed at 5. People were concerned about the housing liability, although they were very, very reserved for it. But, it required them to kind of maybe have more employees there than they would otherwise. I mean, so there was a lot of businesses there that if you looked at it just on a P&L, snapshot P&L, it looked like a mess, right? But you kind of, you talk to management, you look in the Q's and the K, and you're like, okay. There's some things here that they're obviously in runoff mode. And they're paying for mortgages that originated, years and years and years ago, but, they're addressing it, and eventually they'll kind of right size this business, and profitability will look a little bit better. And meanwhile, they've kind of doubled down on businesses that they're good at, and they've kind of gotten rid of businesses that they don't want to be in, and all that kind of stuff. So there are a lot of things that were happening. Oh, and by the way, Buffett's has come out and been very, very supportive, both financially and, just some comments that he's made about Brian Moynihan. And, so that was a little harder turnaround. I mean, I was getting emails from clients all the time. What are you thinking? Don't you know Bank of America's a mess? It's never going to get better, and all this other stuff. And so that's turned out okay. It's now $30, and I think GE has a very, very similar situation ahead of it, where I think I never owned it when Jeff Immelt was there, and I started nibbling when John Flannery briefly became CEO, because I think what I saw, and I was early because I think my first purchase was probably in the high teens, and I've averaged down, so that's not my basis, but I saw John Flannery as almost the antithesis. I saw him as sort of like the equivalent of what Brian Moynihan was to Ken Lewis, where, Ken Lewis, his eyes were very, very wide, and he loved acquisitions, and he loved the idea of kind of building businesses and buying businesses and becoming a financial supermarket, almost irrespective of price. And Brian Moynihan really had a different focus. And so I having that experience, I said, well, okay, I think I see Flannery as kind of a similar personality. I mean, he recognizes that GE lost their way. He realizes that Jeff Immelt kind of doubled down on some businesses kind of right at the wrong time. And there wasn't really a lot of price discipline. And I think GE had always kind of embraced this conglomerate structure and under Jack Welch, and I think they lost some of that discipline. But then the way they went from being a conglomerate to creating a simpler organization, they almost did it irrespective of price. They almost gave away businesses at bad prices and then doubled down on businesses at bad prices. So it was sort of like, they were, a lot of the wounds were self-inflicted. Alstom being an example of it. I mean, the coal business is dying, so why are you doubling down on a power business, that is really, really levered to coal, and then, promising all sorts of like things to the French government and workers and all this kind of stuff. So, but the situation today seems to be even better now that Larry Culp is in charge, and obviously he's got a very, very rich track record at Danaher. When he ran it for like 12 years, I think, from like 2000, 2012. I mean, so I like situations like that where who can just take a fresh look, who has really identified kind of strengths and weaknesses, and is just, interested in kind of blocking and tackling and is doing so in a very, very methodical way. And, Larry Culp has kind of come in, and 2019 is all about deleveraging. It's a reset year. But I think it's going to lead to 2020 as a transition year, and in 2021 being a year where they can start playing a little bit of offense in some of these verticals that are now in a better position to grow. And, so that's a situation that intrigues me. I think his deleveraging campaign is going very, very well. I think he's, raised almost $40 billion in a very short period of time. I think he has the ability to raise a lot more. He is, at least on the last call, not investor call, but on the last presentation he did, he has kind of indicated that power is improving. Aviation, healthcare have been strong. And so I think there's pieces there that if you give a good operator, some assets to restructure around, and assets that might be more valuable to someone else, whole know what to do with it. And I like, if you look at Danaher is the company that's created enormous value that no one's ever heard of. And that's great. Like that's Larry Culp. I mean, to me, it's indicative of the fact that, Danaher had businesses all over the place. They spun off a lot of different businesses. They created value. and they probably ran it with a headquarters of less than 100. Because people were out in the field. That's kind of just the mentality they had, and so I think he's bringing that same mindset to GE, and so that's a harder turnaround that I am willing to. I'm going to take that ride.
I mean, where do you see you could lose money on something like this? I mean, do you think that GE you have to, because some people say GE is kind of a black box in terms of what the assets are worth, and it could actually be worth a lot less. What do you say to someone like that?
Well, I think that. I think every investment, there's a bull in the bear case, right?
Sure.
And you can spin certain things any way you want. I think you have to kind of just look at it in a probabilistic way. And I think G is are there some assets that are worth less? Possibly. Are there some assets that are worth more? Yeah. But you can go back to Tyco, and I think a lot of the things back in 2001, back when Ed Breen took over, were, I think you'd find kind of some similar criticism. With
all of these, you'll find similar criticism with these kinds of situations. With all of these kinds of situations, you'll probably find similar criticism, which is why.
Right. I mean, so G Capital is in runoff mode. Are there things within the insurance business that I think they're trying to, I wouldn't say figure out, but that require estimates? Yeah. Are there insurance regulators that are intimately aware of, how that book looks? Yeah. I mean, do they have an obligation to, obviously protect policy owners? Yeah. I think you got to make a series of judgments. I'm not saying, I'm not really pounding the table on that particular thing. I mean, I think Larry Culp, the deeper he gets into GE, I think every day is filled with probably surprises both on the high and low side.
Do you go though into is your thinking more of okay, I don't know exactly what this is worth, but I think it's cheap, and if I hold this for a few years and things start materializing and the asset value and the business value becomes a little bit more clear to the market, then when I feel it's somewhat appropriately priced, I sell. Is it that loose for you, or do you have a pretty good range of what you think it's worth and where you would sell it at over the next few years?
Nah, I'm pretty humble when it comes to. So I think valuation is that's another thing where, I mean, I could fire up Excel right now and I can give you a range.
I'm not even talking about that precise. Is it just more of I would sell it at book value, or 1.5 times, or is it just, or is it more like the first thing I said, where it's very, very just okay, it looks cheap, there's probably some value here, let's give this a few years to play out, and as things normalize, and maybe I would sell it once it's a little bit more predictable. And
I think it's more the latter. So I think with GE, I think it's more. I think there's a confidence cloud that needs to lift. So I think once that happens, and I think there's credibility around the whole. It's blocking and tackling, and I think the more confidence that people have that on your ability to execute, then they will reward you with multiple expansion. I think it's kind of that simple.
Glenn, isn't it interesting? It's funny, right? I got into Warren Buffett when I was very young, like a teen, 14, something like that. And, the message he would always drive home is, I can make these decisions very quickly. I don't have to explain something in a 10-page report. And I'm not bashing any of these websites that do reports, and there's some really, really smart value investors online. But it's almost as the more you learn, the more complicated people make things. And you can do a 15-page write-up, And I read some of these things and I'm like, holy shit, the guy's clearly a smart guy, but I don't know how you are modeling and predicting all of these things.
And I think the underlying, I use conservative assumptions. Yep. And I think so let's kind of just start with the idea that clearly there's a lot of pessimism as it relates to GE, right?
Clearly, yeah.
Okay.
Just a bit.
So, I think we can argue degrees of pessimism, but I mean, at the end of the day, it's a company that obviously has.
Here's
problems.
The amount of pessimism there is. It's a lot to a shit ton.
Yeah, exactly. All right. So I think that instinct that's the value that you've created, right? So your ability to at least recognize that, to me, is huge. And the second kind of area to create value is, okay, let's go through some of the stuff and let's figure out if it's structural, and let's figure out if maybe the market is just applying too heavy of a discount. And if you kind of come out somewhere on the other side and it's material enough, you're going to do quite well in these situations. I mean, it's not. I mean, I think clearly there is a lot being discounted for GE. I mean, and that shows up in if you read like the last 20 things that have come out in any mainstream publication about GE, they've all been negative. It's sort of, a lot of it is sort of intuition. A lot of it's just common sense. A lot of it is just, companies that are in favor and companies that are out of favor. And it's a lot about, okay, let me just kind of figure out here, why is this out of favor? And do I think that sentiment has maybe gotten a little too one-sided? Do I think that maybe there's a discount being applied that is unfair? I mean, remember, at the end of the day, these are businesses that are going to throw off cash for a really, really long time. And, if people think that today's problems are tomorrow's problems, and if my view is different, then that's sometimes enough.
Yep.
I don't know that you need to kind of get deeper into the weeds than that.
You usually don't.
Yep, I agree with that.
Yeah,
I think at the end of the day, I think and I didn't have, frankly, a deeper.
So here's the problem, right? Is I have noticed the same issue that happens in these business schools as that happens now that I've noticed in the value investing community, where in business school, right? This would not be an appropriate valuation on an exam of how do you value GE. Well, also what you just said to me, if you wrote what you just said as a submission of Value Investors Club, it would be rejected.
True.
So it forces people to overcomplicate things. And I have seen that.
Yeah.
Even in our community, I've seen that.
Yeah, I don't disagree with that. I think that it.
Charlie Munger has said people would be shocked if they saw the way that Buffett looks at some of these things, just how quickly he'll make the decision. Yeah,
I think people want to look. A lot of the write-ups are sort of a way for people to maybe look, maybe smarter, or maybe they feel there's this illusion of control where, okay, geez, I modeled it all out and look what the model says and look what this says and look at the. I get it. I mean, look at GE Healthcare and look at some and compare it to other healthcare businesses that have been. I mean, they're all. You can do a sum of the parts of GE and go through that whole exercise, and it would still kind of get you the same place. There is a tremendous amount of uncertainty. There's a tremendous amount of skepticism that's being priced into GE. And it's obvious. I don't know that you even need to go deeper than just kind of just take a pulse.
I don't know if you can. I mean, that was kind of my point. Is it's such a big company. You're gonna be wrong about a lot of things, and you're gonna overestimate some things, underestimate things. To me, it's a waste of time.
I agree 100%. I agree 100%. In situations like this, I agree 100%.
Yeah.
I think really sometimes your judgment about a company doesn't need to be more sophisticated than, let's just take a step back and let's just kind of observe the obvious. And the obvious is there are just certain companies that are unloved, hated, any way you look at it right now. And then you go through that pile, and some are hated, and justifiably so, because they have structural problems. And then you sort of put them in the too hard pile, right? As Munger and Buffett kind of call it.
Sure.
And then you have companies where, thankfully I had the same observation as Buffett, but obviously I own just equity and he owned preferred stock. So he had some protection and he was able to kind of do some things that I wasn't. But
you can do things that he can't as well. So
yeah, and so I had an observation at Bank of America was like, wait, what are you kidding me? I mean, everything I read about Brian Moynihan in 2011 would suggest that this guy is like a complete buffoon, that he has no idea what he's doing and he talks too fast, and it was all about just all these like kind of nitpicky negative things about him. I'm like, this guy is terrific, and I think the media just falls in love with certain personalities, and he's not really a guy that they fell in love with. I don't know that he's an extrovert. I think he's a guy who just likes showing up, and he wanted to fix things, and I think he kind of believed in what he was doing. And, I think that works, right? It's not necessarily a guy that you might bring in to kind of, take a company from 0 to 100 million, but he might be a guy where if you got $100 billion business and you want to increase the margin profile and you want to right size it and you want to maybe become focused on, the handful of businesses that they're really good at, he's probably the perfect guy. And so, that was my observation. My observation was like, the media has it wrong. This guy is actually the right guy at the right place at the right time. And they have it wrong because if you ever listen to a conference call and 99.9% of the discussion is about either, what happened last quarter, and no one's ever talking about the future, it just gives you a sense of how little people think about, how a business might look 18 months or 24 months down the road.
And not only they're looking
actually thinking about it.
Yeah, not only they're looking in the past, but often the questions are so mundane and technical that whatever the answer is still has nothing to do with the future of the business.
No, they're analysts are concerned about if they think that the company is going to earn 23 cents, and they want to make sure that it's not going to be like, they're not going to come out at like, some higher estimate. Like they don't want to be, so far off from consensus or so far off from reality. They want to make sure, because that's kind of how they're judged, sadly. They're not investors. They're not putting capital at risk. And so,
and this goes back to what we were talking about earlier, that we are in an environment of renters, not owners. And right. That's the competitive advantage if you can think a little bit more long term, in an environment where a lot of businesses are structured not to look at that and actually would lose clients if they just looked at that. The other thing I would add too is that I believe the number is something like only 10% of the market participants now are actual fundamental investors. I believe it's that low.
That's great. That's
wild, right?
For me. Yeah, I mean, it all comes down to supply and demand. And so I would, to the extent I'm looking at a company and I'm not motivated by current stock quote, and I'm not fixated on this, and I'm not trying to buy at 9 so I can sell it at 9.25 kind of thing. To the extent I'm really looking at things that other people aren't looking at and thinking about, that's terrific.
I'm right with you there, man. I think that's a good place to leave this for now.
Okay.
But Glenn, it was an absolute pleasure chatting. Would love to continue the conversation another time. We don't live too far either, so maybe we can grab some coffee sometime or something.
Yeah, it'd be great.
Yeah. If people want to get in touch with you, what's the best way for them to reach you?
So a couple different ways. Email is Glenn, N, at GDS, Glenn David Sam, investments with an S at the end.com. Or you can just go to my website, www.gdsinvestments.com. And
we'll put a link to the website in the show notes.
Link to the website. It's got all my info there. And I am happy to share anything I've put out, including client letters and things of that sort. If people want to get a sort of a closer look of companies I look at, things I think about, how I invest, and all that good stuff.
All right, great. Really appreciate it, Glenn. And for listeners out there, if you go to ericschleien.com/podcast, you can see all the other episodes and show notes and letters from other great investors as well. So, Glenn, I'll definitely put some links up on the show notes, and anything else that you might want to add, I can always add to it as well. So
awesome.
Yeah.
Hey, thanks for having me.
Hey, Glenn, it was a pleasure. Thanks for coming on.
Appreciate it. All right, okay.
All right, take care.
All right, bye-bye.
Bye.
Thank you for listening to the Intelligent Investing Podcast with Eric Schleien. If you'd like to connect with Eric for questions, comments, feedback, ideas, or to inquire about being on the show, please contact Eric at intelligentinvesting@gmail.com. So, in the words of Charlie Munger, I have nothing to add.